All right, so welcome to the StatArb and Quantopian webinar. You've got myself, Karen Rubin, the VP of Product here. You're also joined by Jess Stoth, our VP of Quant Strategy, and Sung Lee, our #1 client engineer. And we are here to talk to you about some really exciting stuff that we're working on at Quantopian. And so I'm pleased to have you all joining us. I see a lot of familiar names here, which is exciting. We will be recording this, as I mentioned, so that we can share it out after. But the other thing is, we're all here because we expect there to be a lot of feedback and dialogue and questions throughout the course of this discussion. Sung will be manning the Q&A line, and so put your questions in the questions sidebar of GoToWebinar, and he'll be watching them and feeding them to Jess and I throughout the discussion so that we can make sure to answer them as we go along. We're going to talk a little bit today about why Quantopian cares about StatArb. We're going to talk about how we think about StatArb and how we're approaching it from the perspective of the platform. And then I'm going to dive into, and what we'll spend most of our time today on is looking through a couple of pseudo-coded examples of how we think how we're planning and working to implement StatArb type algos within the Quantopian system. And this is early. We have people working on it. We expect to have it out within the next month or two, but we wanted to get it out there for your input so that you could let us know if there are ideas that you want to do that you don't think will work with this, or if you have ideas you want to share, so we can make sure that we're taking that into account and delivering something that'll allow you to do everything that you want to do. So with that, I'm going to let Jess take it away and tell you about the Holy Grail.
All right, thanks, Karen. Can you hear me okay?
Ken, you sound great.
Great. So really sort of to back up to a 10,000-foot view, we've talked a lot lately about Quantopian's mission and our intent to launch a crowdsourced hedge fund in the next year. So this is a slide that I've been presenting a lot at meetings and around up and down the East and West Coast, talking about our real founding concept that we think we're going to be able to generate great consistent return streams for investors by crowdsourcing lots of uncorrelated but positive Sharpe ratio strategies. So what do we mean by that? This plot really just shows, based on simulated results, that if you combine more and more return streams, which for our purposes we can think of as more and more crowdsourced algorithms, right? So think of each algorithm that someone from the crowd might write as now sort of a meta asset or a return stream. As you combine more and more return streams, that's moving along the x-axis of this plot, you really only get a benefit in terms of your overall portfolio's Sharpe ratio if those return streams are uncorrelated with each other. So if you look at sort of the faintest pink line at the bottom, that's looking at when return streams have about a 60% correlation with each other. So the marginal benefit of adding each additional return stream is really negligible. If you move up the ladder to the darkest red line trajectory, you can see that if each return stream you add is uncorrelated as far as time series correlation goes with the prior return series or all the rest of them, then now suddenly you're climbing a very steep slope in Sharpe ratio. And so that dark red line is really what we're going for, which is going to be to find 15, 20, 30, maybe several hundred return streams from the crowd that have low pairwise correlation and will allow us to build one sort of risk-adjusted and consistent return stream, and that's what we're going for. So, part of why we wanted to talk about StatArb strategies and the ability to support sort of larger cross-sectional algorithms on the Quantopian platform is that that's one of the directions that we think is a very rich seam for finding uncorrelated return streams. And so those are the tools that we want to give you in the crowd, and we want to make sure that we're building the best toolkit that allows you to get access to sort of new and creative ideas that aren't sort of all making the same concentrated bets. One thing that Karen won't talk about today, but just to give you sort of another dimension we're thinking about is, so in addition to giving you tools to find uncorrelated alpha inside of one market like US equities, you're probably also thinking that the best way to achieve sort of real diversification is by adding additional asset classes and markets. And so that's another dimension that we're working on at Quantopian, is looking at, adding other markets like futures and eventually international equities. Although right now today we do have ETFs that you can trade. So probably another future webinar I could imagine Karen giving would be saying, hey, how to use ETFs to represent other markets and get more uncorrelated return streams there. So that's sort of the overview that I wanted to give, and I'm going to be on for the duration of Karen talking about this webinar. So if you have also questions at the end about our progress in analyzing algorithms in the contest for the fund or anything like that, I'm happy to answer those type of questions too.
Awesome. Thanks, Jess. So if the Holy Grail is finding uncorrelated return streams, that's brought us to this idea of StatArb. And when we talk about StatArb, we're talking about it in the most broadest sense of it. And I'm going to give a basic framework for what I mean when I say that, because it's not just a co-integrated pairwise combination. We're looking at something that, or we hope for something that's a lot more broad than that. And so the first thing, this is just a breakdown of how I think of the structure of these types of algos. You start with the entire universe of stocks, so roughly 8,000 US equities. You filter down to subset. Maybe it's the Russell 2000. Maybe it's all securities that have never had a stock price below $2 or within some range. But you take a first swath at filtering it down to a couple thousand securities. You then rank that subset based on some, filter or factor that you've created, that you apply a ranking. You long the top X% and short the bottom X% and rebalance on some scheduled frequency. And so when we talk about StatArb, I just wanted to go through that. This is the type of generalized structure we're thinking about for these algos, because it is a bit broader than just, it's a factor-based algo as opposed to just specifically StatArb. Any questions there, Sung? We good? All right, excellent. So as we started attacking this problem a couple weeks ago and saying we need to do these types of algos better, we quickly recognized that there were some pretty significant limitations to the platform as it stands today. The first one we've talked about before, I think Simon brought it up on the thread in the forums, was before trading starts does not include pricing data. Before trading starts is the only place where you can access the entire universe of securities, and you're limited to just fundamentals data within before trading starts. So your universe selection process is only using fundamentals data. And there's a lot of reasons why you would care about the pricing data as well. The second thing is the universe size of 200 securities. So once you've narrowed down your universe, you pass it into handle data, and you can only have 200 securities, which in the grand scheme of these types of algos where you're comparing baskets of stocks, that's just not really big enough. And lastly, what this leads people to doing is, instead of doing the work within before trading starts where they don't have pricing data, they try to build models that analyze the entire universe or the universe of 200 securities within handle data, which is limited to 50-second bars. And so we've seen a lot of people timing out on their models because they're trying to run it within an individual minute bar and just running out of time and memory. And so knowing that these are the limitations, there were some things that we've talked about in the community, or we've heard people ask for, which is straight up, just get pricing data in before trading starts, or just increase the universe size. But we took a step back and we tried to think about this holistically from the viewpoint of our platform and what could this be in kind of the best implementation. And we've come up with this idea about factors, filters, and classifiers. And I'll explain what these are, and then we'll dive into a bunch of examples using them so you can see where we're headed. So a factor, I'm going to start with a filter. A filter is something that just returns true or false about an individual security. So this could be, does the security have a market cap greater than $1 billion? Or does this company have a female CEO? But it's something that is inherently true or false. And when you look at the universe of securities, you could basically take a narrow down of identifying every company that meets this criteria, that is true or false. A factor is different from a filter because a factor actually returns a value as you've passed different securities through it. So a factor might be, what is the actual market cap for a security? Because I need that in order to make decisions about what my algorithm's going to do. It could also be something like the closed price yesterday over the closed price 60 days ago. So it's an actual numeric value that I'm going to use to help rank and weight my universe of securities. And the last thing is a classifier, and a classifier returns membership in a group. And so this, for example, could be the Morningstar sector code. Another one is like the decile within a universe that the security lives within. One example of this that became clearer from talking to a bunch of users is that you might have a ranking mechanism that is very different dependent upon the type of company by sector that you're doing. say it's just market cap, or say it's earnings yield, and what the general earnings yield for a tech company is very different than for an industrial company. And so you wouldn't rank these against each other. You would take your universe, divide it by sector, rank the universe within each sector, and then pick the top and bottom segments of those sectors to make your portfolio. And so a classifier allows you to do that. And so those concepts are a bit arbitrary, just spewed out like that. So what we're going to do is we're going to dive into a couple of examples. And I seem to have lost my focus. There we go. So there are two examples that I'm going to go into depth. The first one is as simple as it comes. Build a market cap weighted long only portfolio composed of mid-cap stocks, and we'll dive into that. And then the next one is more complicated. We're going to take a look at all mid-cap stocks. We'll compute the earnings yield Z-scored by sector. Then we'll build a portfolio that longs the top decile by Z-score and shorts the bottom sector decile, rebalancing to a market neutral, market cap weighted portfolio. When we think about these, there's two kind of modes that we believe people will build these in. The first one I think of as prefab, which is where you're using kind of generated factors and filters and classifiers of standard elements. Those would be ones, we'll have a factor library that Quantopian offers, and you'll be able to use those without building your own factors, filters, and classifiers, but leveraging the ones that already exist. You can see a world where community members build factors and share them with each other, and you're leveraging these. The other one is where you're building custom factors, and you might have a library of your own custom factors that you don't share with anybody because they're sort of your secret sauce. And this is a functionality that we're planning to do as we continue to expand this out. But I'm going to show these examples, some of them both in the prefab version, and then also as you would do it if you were defining your own factors, filters, and classifiers. So feel free to pop any questions in there. One disclaimer before I dive into the code. The code is all pseudocode. It might not be perfect. There might be things there that don't necessarily agree exactly with the right structure. Just know that this is trying to show the general idea, and all naming conventions are subject to change. One of the ones that we've been talking a lot about is the idea of classifier. It might be better called a grouping, but we're still discussing those internally. So if you have strong thoughts on any of the names that we're using or any of the function names that we talk about, please let me know. All right, so let me just go from there and dive into into the IDE. So this first example is the first one that I spoke about. We were going to build a market cap weighted long only portfolio composed of mid cap stocks. Now, this example, I'm showing it in the prefab version where we're using predefined factors and filters that Quantopian, in this example, has built and is available through our API. So the first thing that you might do here is import the factor market cap. And what this does is it's a factor, so it returns the value of the market cap for a company. The place that you use these factors, filters, and classifiers is actually within initialize. And so the way to think about this is you're identifying your universe, filtering it down, ranking that portfolio, and that's all happening at the beginning when you first kick off your back test. And then we use schedule function to schedule the trading to happen when it needs to happen. So in initialize, which again happens at the very beginning of your back test or of your trading, you set up what needs to happen and schedule out when it's going to happen in the future. And then, as you can see in this example, handle data has actually nothing in it. It all happens within initialize and takes care of setting everything up. So the first thing we do, like I said, is import this factor market cap. And then in initialize, we're going to use that. We're going to create a variable called midcaps. And that midcaps will be set to market cap dot between 1 billion and 10 billion. And so we're basically looking for the midcap portfolio, and we're taking the entire universe of stocks and narrowing it down to just those with a market cap within the range we're interested in. And that will become the midcaps variable. And then we use this new API method called add portfolio that essentially accepts the filter that we want to use, which is the midcaps filter we just created up here. It allows us to identify how we want to weight the allocations of the portfolio, which is the factor. So the weight by equals that same market cap, because we said this was a market cap weighted portfolio. We can identify that we basically don't want to accept any new leverage in this portfolio. We don't want to use leverage. So it's going to be a leverage of 1. and we'll rebalance, and this is using the same date rule that we use within schedule function to say that we're going to rebalance this at every month start. So at the beginning of every month, what will happen within this algo is that it will go and it will recalculate all of the mid-cap companies between this range as my filter. It will get their most recent market caps, and it will then rank and weight the portfolio by that market cap and rebalance it, and it will all happen automatically. So that's the most basic example.
So Market Tech is asking a question, and the question is, all data, given this example that you just showed, all data that enters the filters, factors, and classifiers must come from within the Quantopian platform. What about the fetcher data that we'd like to import at the time of before trading start? I have custom factors that I want to apply to the S&P 500 and have factors like this apply to that at the time of processing.
So I think that's a really good example. And one of the things that I'd love your weight on this, but we definitely want to make this a world where you can create those factors within Quantopian. So you're leveraging data here to calculate them. And so I'd love to talk with you more to try and understand, is there data that you need in order to be able to create them here within the factor library so that you can have that calculation being done here as opposed to having to feed it in through Fetcher in the future. That is the direction where we want to head. Jess, does that map to what you believe?
Yeah, I guess right now, if you're using Fetcher, you do have the chance to do manipulations on the Fetcher data as you're bringing it in, I think. So I would say, like, when we get further down the line of building this version 1 of this API that Karen's demoing, we'll need to build out an example that looks at what if you want to use your Fetcher data today and have it play side by side with this part of the API. And so I think really we should just write that down as like we need an example that shows what you could do with the functionality in the first version, and then what would be the gaps between what you'd really want to get to. But then yes, like in the long view, our goal is to continue to understand what data sources people are sucking in with Fetcher and try to be able to enable more and more of that analysis to be done on the platform.
Yeah.
Cool. Second question. In this case, is the market cap the fundamentals value of shares outstanding multiplied by the most recent price from, say, yesterday?
Yes, that's it. That would be how we would say this factor would be defined, obviously, and we would have to have within the factor library the ability for you to see exactly how market cap was defined here. But yes, assume a very basic definition. And one of the benefits of this system is we think that it can be flexible enough where we can have a version of the factor market cap that's defined as exactly that. But then say you have your own version of how you want to calculate market cap that uses, instead of yesterday's close price, it uses a 30-day average price or something along those lines. You could create that factor and use that because you think it's a better signal.
Cool. And a final question that's not related to the example that you just showed. Someone's asking, are there any plans to provide a decent optimizer in the Quantopian platform? He says in any good platform, there should be an easy-to-use optimization software. I think this question is asking more about the parameter optimization stuff.
Yeah. So with regards to that, our hope is actually to leverage the research platform to do that. And there's a couple of things that need to happen to make research capable of doing good parameter optimization. Things like being able to kick off back tests from the research environment. So that you can set up your algo, kick off 100 back tests to run, get them to run in parallel, and then get a nice heat map results showing which parameters would result in different kinds of things. We haven't built that yet. It's definitely in the roadmap as something that we want to do. Excellent. So I'm going to now dive into our second StatArb example. This one is a bit more complicated. The approach I'm taking is still a prefabbed approach where the classifiers and factors we're using are predefined. I'm also going to show this example and show you how you would define your own factors and classifiers. So we'll see this one twice. So just to reiterate what we're looking at here, we're taking a look at all mid-cap stocks. We want to compute the earnings yield Z-scored by sector, and then build a portfolio that longs the top decile by Z-score, shorts the bottom, and then rebalances to a market neutral, market cap weighted portfolio. So the first thing we do is import the classifiers and factors that we need. So the classifier we're going to import is called Morningstar sector code. This is from the Morningstar fundamental data and gives us the sector code for every company. The factors that we're importing are market cap and earnings yield. And in the next example, I'll show the calculation of that earnings yield factor. So in this example, in initialize, what we would do is start off the same way we did with the last one, where we basically take that first filter from the whole universe and we say, let's just get those securities that have a market cap between 1 billion and 10 billion, and we store that as the filter mid caps. And then we we create a new factor called normalized yield. And what we do there is we take the earnings yield factor that's predefined that we identified up here, and we use a .normalize by function to identify we want to normalize that earnings yield by the Morningstar sector code, the classifier that we also imported, and then we're going to use ZScore in order to do that. And that gives us a new factor called normalized yield that we can then call upon as we construct our portfolio. We're going to combine then the mid-cap factor, a filter that we created, and the normalized yield factor in order to create our long and short filters. And so this is how the algo will know which companies we want to long and which companies we want to short. And so long filter is basically mid-caps. So first we take the mid-caps, then we get the normalized yield factor, and we take the top 10%. And we do the same thing for the short filter where we take mid-caps. We again call .then normalized yield, and instead we pull on the bottom 10%. So that's how we identify our long and our short filter. And in this example, we're going to once again use add portfolio, and basically we're going to call it twice to add this portfolio and basically do the buying and rebalancing for us for this portfolio. So in the first one, we basically use the filter that we defined. Long filter is the filter. We're going to weight by market cap. And in this case, because we have both a long portfolio and a short portfolio, we're going to set our leverage to 0.5, since half of our total available capital will go to the long filter and half of it will go to the short filter. And we'll use the same rebalance rule that's just like schedule function to rebalance it at the month start. Obviously, this could happen at any point in time. This is just how I'm choosing to do it. And just like with schedule function, you have the ability to set specific time rules and all of those things, but just to keep this simple, that's how I showed it.
And Karen, hey Karen, one quick question, just to be clear. Would this actually be, would you do leverage equals positive 0.5 for your longs and negative 0.5 for your shorts?
That's a good question. I think the way we had talked about it was it would just be 0.5 for both, but that's a good question that we should probably clarify. I think in theory it needs to be negative 0.5, right?
I think so, because I think that's how you're telling it whether you want long or short. But anyway,
we'll nail that one down. And also my comments here are wrong. So in any case, you can tell I was changing this yesterday. So then we create another portfolio where the filter is a short filter. We again weight by the market cap with the leverage of, I think Jess is right that it should be negative 0.5 to indicate that we're shorting these. And then the date rules is the same, so it's also rebalancing at the month start. The other thing that we're going to do here is we're going to add a factor. And so what we can do here is we're adding a factor that will be called normed yield, and we're just passing through the normalized yield information that we specified up above. What you do when you do this, essentially that attaches that information to the data object that's passed into handle data. So you can call then data.factors normed yield and store that in a variable. And what that gives you is if you wanted to then use any of the information, the factors that you identified within initialize as part of your handle data, you could. So say you wanted to make sure that whenever this was run, there wasn't anything wildly out of balance and you're going to check that on a more regular basis, you could do that by adding the factor into handle data and passing it through.
So a couple questions on the example I just showed. Simon first asks, so basically this is a cross-sectional Z-score of each stock with respect to the average of that factor across all members of that class.
So it's actually classifying them by sector codes. So I think if I'm understanding the question correctly, it's taking the earnings yield and normalizing it within the sectors using Z-score in order to do that.
Okay.
Right, Jess? Does that sound like that's the right answer to that question? I just want to verify on the finance side.
Could you just reread the question, Sung?
Yeah. Simon asks, so this is a cross-sectional z-score of each stock with respect to the average of that factor across all members of that class.
I think that's right.
Yeah.
The second question is, what is the holding horizon that you're targeting, and are you going to build out a portfolio optimizer? What I'm hearing so far doesn't sound very much like StatArb. Mixing alphas, in parentheses, mixing alphas through a portfolio optimizer, relatively short holding horizons. I'm not really sure what that question is asking.
That sounds like that question is more about the fund that we're going to be constructing as opposed to about the API changes. So I'll answer it in that spirit and then they can re-ask. So for the fund, we're still in really early stages of analyzing all the algorithms we're getting in through the contest, and what we're targeting in terms of the holding periods for algos that we want to put into the fund are anything from intraday to rebalancing monthly or weekly or monthly, but not obviously you can't go too much more frequent than intraday on our platform, just given the constraints of the way it's constructed. And if you go with rebalancing or trading that's less frequent than monthly, we don't think we'll have enough data points to validate how the strategies are working. So right now we're sort of more constraining them based on what we think is going to be practical for us to evaluate. And then down the line, we might get more specific in terms of what we can actually construct a portfolio with. So that's the first part of the question. Then I think the second part of the question was about, will we be providing a portfolio optimizer as part of the Quantopian platform to end users, I think was the second part of the question.
Yep.
So at some point, we think that would be really cool. I think that it's not part of this API design. So this API design will let you get to a universe of stocks that you've filtered down based on some sequential set of cross-sectional criteria, and then you'll be able to run like a daily model inside of this, whether we call it before trading start, or you'll have an analysis period where you can run a model and you can come up with your own weights. We won't be giving you like a plug and play portfolio optimizer there. On the research platform, possible we could try to whitelist a portfolio optimizer library in Python that somebody else has written.
Yeah.
Separately in the fund, we'll probably be using an off-the-shelf vendor-provided portfolio optimizer. We're looking at and evaluating a couple of those. It's another step in complexity to try to offer something like that for sale to our end users.
Yep.
Really because our end users, like right now, tend to be individuals who want like an individual type of price point, and the institutional quality portfolio optimizers that you might be able to offer or buy at a hedge fund, like someone like Northfield or Axioma or Barra. They don't really currently have, that I know of, a great model of selling their tools to individual users at retail price points. However, I think that would be really super interesting, and it's something that down the line we would definitely be interested in exploring, but we don't have immediate plans to make that available.
Yeah.
Cool. Alex, if you have more questions on that, feel free to ask. We're going to move back to the example that Karen showed.
Yeah.
Simon asks, how does all of this interact with the 200 symbol limit?
Yeah, that's a great question. So within Initialize, you'll be able to access the entire universe. So for filtering and setting your factors and ranking and everything, no universe limit. We are presently working on, we actually have it just being tested now, an increase to 500 securities. So we're planning to raise the symbol limit to 500 within the very near term. And then our goal, very specifically because of this whole approach, is to get up to universe sizes of about 1,000 securities. So you could long 500, short 500, and that's where we're headed over the next couple of months. So expect 500 soon, even within, regardless, if the universe size goes to 500 or when it goes to 500 and this launches, you'll still be able to filter based on the entire universe and rank based on the filters, and then pass through up to 500 securities for trading. We're going to get that up to 1,000 securities for your portfolio size, but that's the direction.
Cool. Next question. In this example that you've showed, you've set the rebalance frequency to be every month.
Yep.
Can you time it so that you can do it sometime during the trading session?
Yeah, you absolutely can do it during the trading session. We're planning on getting down to, so as we talk about this, the rebalancing, we think daily makes sense for rebalancing, but you'll be able to set specifically within the day you want it to happen. I don't think within this we're not at this point planning to work around doing intraday multiple different types of recalculating, but you will be able to rebalance it daily and identify when during the day you want that to happen. So say it's critical to you that it happens in the middle of the day and it's nowhere near the open or the close, that's totally possible.
Awesome. Final question, and this one's by Market Tech. You seem to have added a 4GL API to your platform. I'm guessing that means a more like high-level API, and not additional raw tools that we've gotten used to using like Numpy, Pandas, SciPy. Why did you go to this high-level route rather than adding more basic tools?
Well, so I'm not actually sure what a 4GL API refers to, but what I've shown thus far is only the kind of approach where we are defining the factors and filters and classifiers for you. The next example is the one where I show you how to do it on your own, which I think will give you more of the kind of raw functionality that you're looking for. Why don't we dive into that? And Market Tech, if I'm not correct, please let's talk about it some more. So StatArb example number 3, this is the same algo that we just looked at, except in this example, I'm going to define the factor and the classifier that I need to use to show how that process would be done. So once we take it to this level, we have to import the actual data sets that we're interested in using. At this point, it's US equities and Morningstar fundamentals, but you can see a world where we have more data sets that you're pulling from. You can also see this being maybe where Fetcher plays in. I'm not entirely certain of that yet, but we'll have to figure that out. You then also import from Zipline the filter factor and classifier so that we know that we're working with that. We're going to identify right off the bat a factor that is just the market cap. And so to do that, I say market cap equals factor from column Morningstar fundamentals.morningstar market cap, just to get my market cap up top, and I'll show you where we use that later. Then I'm going to define 2 factors, or a factor and a classifier. The first factor is the price to earnings, well, it's the earnings yield that we're doing. And in order to calculate this, we set it up as a class, and our input for that is that we know we'll need in order to calculate this. It comes from Morningstar fundamentals, and we know we need the price to earnings ratio. We then define that what we're going to do is take that P price to earnings ratio and return 1 over the price to earnings ratio from yesterday. And so this is us defining that very basic factor. And you could do whatever kind of math or analysis that you want within a factor to have it return. But what this will return for each individual security is that earnings yield. The next one for the sector code is exactly, this is where we identify a classifier. We again take the import of the Morningstar fundamentals.sector code, and all we're returning is the most recent sector code for Morningstar. Then we go down into initialize, and this is where we're going to leverage these factors. So mid cap equals market cap. That was the first one I defined up here at the top, market cap. Dot between, same exact thing we did before. We want 1 billion and 10 billion as your market cap. The normed yield here looks very similar to what we did before, where we basically take the earnings yield, which is the factor we've defined up here, dot normalize. We identify the classifier is the Morningstar sector Morningstar sector code that we've identified, and again, we're going to do it by ZScore. Now, we're going to do a different type of function here to add the universe. As opposed to doing add portfolio, which we did previously, we're going to do add universe so that we're passing the universe through to a function called myRebalance. So in this example, we're assuming that a lot of quants won't want to trust the Quantopian portfolio rebalancing function to do it for them. They're going to want to take ownership of that a little bit more carefully and identify when it needs to be done. So in this case, we're going to add our 2 universes. The first is called longs, and we basically take the mid caps and we do dot then, calling normed yield dot top 10%, where the recalc frequency of this universe is that the month start. We create a second universe, which is called shorts. It's exactly the same, except we're calling the bottom percent 10%. And we'll also pass through the yield factor, which is the normed yield, and the market cap factor to pass those through. And then we call schedule function. And in this example, we're going to call a function called myRebalance, and we're also going to call that month start. Now, if I were actually writing this, I'd have to think a little bit about if both my universes are getting recalculated every monthly and my rebalancing is happening monthly. I might want one of these to happen on the first day and the other to happen on the second day, but you need to make sure that the alignment works. Handle data will then be a pass, and my rebalance function will use the get universe, kind of the sister to add universe, to get my long function and store that as longs. It will use get universe to get my shorts universe, defined again up here. And then I'll just use a rebalance function to essentially say, I want to take from the longs universe, and I want to get that universe and rebalance it or weight it by market cap. And again, my leverage, this actually, as we discussed, needs to be negative. My leverage of 0.5 and the strategy for rebalancing this is going to just use a basic VWAP. And we do that twice, once to rebalance the long portfolio and once to rebalance the short portfolio. We have a bunch of, I kind of want to show one more example that's in this same vein, which is an example that came straight out of the community. So we talked to a lot of users about this as we were designing it. We then designed it and started working on it. And then Bo Dong, one of the community members, added this to the portfolio, added this to the community and said, this is what I want to create. And he basically wants to create a first factor where it's the trading volume over shares outstanding. And then a second factor, which is the price of the current day over the price of 60 days ago. Rank the Russell 2000 stocks every month, long the top 5, short the bottom 5. And so you can see here pretty quickly what I'm doing is exactly the same. Factor 1 is identified here as the volume from yesterday over the shares outstanding from yesterday. And factor 2 is essentially the price of yesterday over the price of 60 days ago. We returned both of those, and he didn't specify exactly how he wanted to combine factor 1 and factor 2 in order to rank his portfolio. So I called this magic math and just multiplied them. But then you would add your long universe. In this example, I did something where I said, well, let's pretend there's a world where Quantopian defines a filter that is the Quanto 2000 that's representative of the Russell 2000. That's something we'd really like to do because I don't think any of us want to pay for the historical Russell 2000 information. But we know enough about that, so we're thinking we could define something like that. You do Quanto 2000.then, apply your magic math, factor combination, take the top 5%, do the same for your shorts, and from there it's exactly like the last example that we just looked at. So it was great validation for us to see as soon as we've identified this, someone putting an example in the portfolio of what they would hope to do. And I would love more examples from you similar to this, written in English so that we can try and pseudocode them up and make sure that our system makes them functional.
Simon had a comment, and he asks, what do you think about including various ways to reduce turnover in the rebalance function?
Jess?
Yeah, I think that's a great idea. And actually, so there's nothing in these examples yet that shows that, but I think what I wanted to do is even maybe step back to a little bit of what I think one of the past questions was about, like, why did we decide to focus on this high level API work as opposed to like adding more low level libraries? And I think it actually ties in nicely with that question about, like, you know, making it more practicable to trade this. So really our whole intention with this is to think about making it as easy as possible for quants to focus on where we think they're going to be able to generate alpha, which is in insights around, you know, factor analysis and figuring out, you know, what do I think is the way to build a model that's predictive of future returns. And so this workflow that we really want to make super easy is scouring the universe of all possible securities or traded instruments and ranking them, filtering them, creating multi-factor models, and saying, this is the portfolio that I want to be in today. Now go ahead and get there. And so this example showed getting there with VWAP over the day. Another way to make that simple would be saying, yeah, this is the portfolio I want to be in. Go ahead and get there. But oh, by the way, here's a bunch of real world constraints. You know, this is what it's going to cost me to trade. As you start to get more and more sophisticated about those constraints, you start to back your way into basically wanting a portfolio optimizer, right? So I think we'll hopefully be able to add those levels of sophistication kind of one at a time. And this API design is really intended to be sort of the first step that makes it a lot easier to get there. And it's something that we thought now is the right time to do, because when the API was sort of first designed for Zipline, really a lot of the examples that it was built around were sort of single stock momentum trading examples. And so they were, right, like the classic Apple example that we've got still on the site today. And they were very focused around, hard coding a stock or a list of stocks and following that stock's price behavior over time, which was the only data that we had when we first launched, and making trading decisions based on it. And we said, hey, look, if you look at what more sophisticated quants really want to do, they want to be able to have an analysis that looks across a big cross-section of stocks and considers them all on the same basis, doesn't have survivorship bias, does something smart to pick out what portfolio they want to be in, and then probably like a lot less of their sort of critical IP is in exactly the trade execution to get there. We think that that is a bit more commoditized, and that's like less where we want to focus. We want you guys to have to spend less time focusing on that. So that's sort of what guided the decision to spend this effort in putting some work into this high-level API. So yeah, like more sophisticated ways of getting from portfolio A to portfolio B would be great future improvements that we would want to offer.
Gotcha. To go back to a question that you answered before about the holding horizon and the portfolio optimizer, Alex says his question was about the API, not about the fund. As far as he can tell, what you're describing is an interesting framework for quantitative value research. That's not actually StatArb. And he says StatArb requires intraday rebalancing and automatic mixing of alpha factors through tools like Black-Litterman optimization. Regardless, for the platform that you're providing, what research tools are you planning to provide to help quants identify viable strategies? So I guess the first part of this question is that he's saying that,
yeah, Karen and I were talking about this. So there's a lot of like loaded terminology, and we have, for internal reasons, at Quantopian sort of chosen and applied this StatArb label to something that really, probably me, as for coming from a quant background, would think of and apply maybe more of like a factor analysis or value analysis to it. So yes, our terminology is not perfect. We intend to be able to support sort of more generic, really specific StatArb workflows.
Right.
These examples are not really great examples of that. So like, yes, that's right. Terminology is like something we continuously struggle with. But nonetheless, these are sort of the examples that we do want to support this type of workflow. So the second question was around like research tools.
Yeah.
Basically, how does he scan over lots of ideas?
Yep. Okay. Karen, do you want to take that one?
Yeah. So actually, one of the things we're really excited about with this approach is that the factors, filters, and classifiers, the plan is to have them be both available within the Quantopian backtesting and IDE, but also in the research platform. And so you could identify factors there, you could access the factor library, you could combine them and then look at what the rankings look like and see if you're finding something interesting. And then the next thing that we were just talking about the other day is we've got an approach for how we believe we can build, super high speed back testing that will get you just really quick answers to whether or not you're heading in the right direction within the research platform. So you can then just, run through a whole bunch of different things using the factors and the filters, figure out what's going on before you actually spend the time writing your algo and testing it in a full back test.
Cool. The final question by Marketech, and I'm not exactly sure what he's asking, is OEX is critical. However, not knowing what/how the queue is providing may make or break a strategy. Do either of you know what OEX is?
Yeah, so order execution management, I guess, or order execution. So we really would like to focus for the fund on strategies that are not extremely sensitive to order execution, right? Like our technology is not set up for low latency, and it's also, I don't think, very well set up for strategies that are extremely sensitive to order and execution management.
Right.
So right now, the way that, that is not a high-tech part of our platform. You have a once per minute ability to send an order to IB. It doesn't have to be a market order. So we've enabled more sophisticated order types like VWAP. I think it's VWAP best efforts and relative orders. So what I would imagine is when we decide what the type of order and execution management we need for the fund is, right when we launch our fund, we're going to need to integrate, with a prime broker, and so we'll sort of have a, new piece of our technology stack that will deal with how we send out the orders from the algorithms that are in the fund.
Right.
So we'll probably look at evaluating, like making that piece more sophisticated, but I think we still want it to be modular, and it's not something that for the Quantopian fund we're particularly thinking that our algo writers are going to come to the table with like a lot of expertise in. We more think that we're likely to get people that can come to the table and write interesting alpha strategies and then say, okay, again, like I sort of fell back to saying, here's a portfolio that I want to be in today, get me into it in, as cheaply as possible. And then, we'll try to do that. So I should also say that that's definitely a piece of overall Quantopian domain expertise that is not something that we started the company with lots of expertise in that area.
Right.
But at this point, that's something that we're extremely cognizant is going to be important for us going forward. So it's something where we've got some consultants that are working with us, and we're looking, and I think in the near term we'll probably be bringing somebody on who's got pretty significant experience. So that part of our platform will get a lot more sophisticated, which is a little bit of a rambling answer, but I still think that our near-term plans are going to be more around not expecting the algo writers to be doing sort of super sophisticated stuff around how their trades are getting executed, just because it's not something I think that, first of all, we don't think that's really kind of where the core value is going to come from our user base. I'm sure there's a subset of people that would be really interested in those types of strategies, but I don't think it plays that well with our technology stack the way it's built right now.
Gotcha.
And if I misinterpreted that question, could certainly re-ask it.
Right. Okay, cool. The next question, I think this is more for Karen. Do you have any plans or directions to include this FFC model in before trading starts?
Yeah, so I think what you're getting at is you're still going to want to be able to use the factors, filters, and classifiers and have them run kind of before the trading day begins. And yes, we plan to enable that functionality. It's probably not going to happen within the before trading starts function. It's going to happen still within initialize, but you'll be able to schedule it to occur before trading starts, if that makes sense. Being confusing because it's the same terminology, but yes, you should be able to run this. You will be able to run this before the day starts so that you can make all your rankings happen based on heading into the market.
But to be specific, it's not going to be in the method call.
Right, it's not going to be within the method call before trading starts.
Gotcha.
Awesome. So that looks like we've exhausted the questions there. This has been really great. You guys have really asked us what I wanted us to in these questions. I'm going to bring them over to the dev team so that they can see them as well. We've recorded this. We'll be sharing it. We're going to have some follow-up for all of you. Just a couple of things. One is the first version of this that launches will likely be with predefined factors, filters, and classifiers, and then we will add on relatively shortly thereafter the ability to customize your own. But I'm going to need to come up with a list, and Jess and I are working on this, of what those initial ones might be. We would love all of your input. And secondly, when we get this, we're going to need beta testers early on before it goes to the entire community. And I would definitely love the people that signed up for the webinar and are really interested in this to be among that group. So if you're interested, please feel free to reach out to me, Karen@quantopian.com, and we'll go from there. But thanks again for joining us, and we'll be in touch soon.